Hello, everybody. Welcome to Wednesday. The S&P 500 was down 4% today. Really, the big catalyst today was Target. They reported their earnings. They missed by quite a bit, which their profits were down, essentially, even though their revenues, their sales were up 4% across the board year over year. And they cited inflationary pressures. Basically, the cost of trucking and transportation, cost of gas was a lot higher. And they weren't able to pass that along to their consumers. Again, keep in mind that Target is probably a lower cost place with a more price sensitive consumer, because Walmart reported yesterday kind of the same thing, actually. But if you look at Home Depot, who also reported yesterday, their earnings or profits were actually higher than expected. And they talked about how they were able to increase their price and still had strong consumer demand. So I think it depends on what kind of company that you're involved in, but it does point out the big worry for the stock market, which is just the fact that if costs continue to go up at a really fast pace because of high inflation, eventually there'll be lots of different companies that can't raise the price because of consumer demand issues and starts to fall off. And then that will compress the profits of these companies, and profits could come down at a rate that's, less than expected. And so the market, is down. And that's kind of one of the things we've been dealing with, all year as far as that goes. And one of the things to keep in mind here is that, going forward, when you look at these types of downturns, there's really two different types. There's the one that happens about every 3 years, where we get kind of that 10 to 20% drop, but there's no recession. The economy hangs in there. And then those come back fairly quickly, right? Average of 15% downturn since World War II for those scenarios. The other scenario is that one where there is a recession, and it does happen. And then that's usually about a 36% drop on average. And so really, in my opinion, you want to watch out for the big ones. Now, there aren't very many of them. If you go back to 1929, we had the Great Depression. We had the oil shock of 1973, the tech bubble of 2000, the financial crisis of 2008, and the pandemic of 2020. So there's 5 big downturns since 1929. And those are the ones that personally I don't want to sit through and wait, because the recovery time can be quite long. But you have to be very careful to make sure you know which one you're in, because the ones like we've have on a normal 3-year basis with no recession that happens, they can come back very quickly. As a matter of fact, within 4 months on average. And so if you get out, it's very easy then to have the market run back up, and you're actually getting back in at a higher point, and you would have been better off just staying in there. That's where we're at right now, because we're looking at the economy. You look at the current economy, it's doing great, but that doesn't help you, because you can't wait for the economy to fall. The market will already be down substantially. What you really want to do is look at these leading indicators. Look at the projections for earnings, which right now are great. The rest of the year expected 9-10% per quarter, expected to have higher earnings next year. But watch those, which is what I do, and see if there's an erosion of those projections at some point in time, kind of signaling that earnings might not be doing as well as we expected. So far, all the companies are beating their earnings expectations. As a group, 77% of them beat expectations for the first quarter, had a 9.1% growth, for example. So that is not happening so far. The other thing that I watch, and maybe one of the more important pieces, is the Conference Board's leading economic indicator. This is a basket of 10 indicators. It has a great track record of peaking out 4 to 24 months before a recession. It is currently at the all-time high. It has not fallen at all so far. The report that came out last was from the end of March, so we're still waiting for the end of April. Report should come out shortly, and we'll see what happens there. I'll let you know. But we're looking for a decrease of some magnitude, at least 1% from that high historically. So if you go back to 2008, for example, that was a 57% stock market loss, and it took almost 5 years to come back. So sitting through that is just really difficult, especially for retirees, which make up a large portion of my practice. And so what happens then is that once the 200-day moving average starts to fall on the S&P 500, that signals to me that the stock market's going down. So I need that. And then secondly, I need those leading indicators to come down. 2006, late in that year, leading indicators started down. Nice early warning. And then 2007, the 200-day moving average started down. So if you got defensive at that point in time and pulled some of your money out of the market, or got into more defensive stocks that fall less, or whatever it might be, you would have been saved yourself some real pain there, because that would have been about 15 to 20% from the high. And again, the market ended up down 57%. It's super, super hard to figure out when to get back in. It's actually a lot easier to figure out when to get out than it is to get when to get back in. But if you are right, and it's one of the really big downturns that happen because the economy also falls, then it's not that difficult to find a spot that's lower than you got out, because the market falls so far. And so anyway, that's what we're looking at right now. 200-day moving average is down. Okay, so the market is definitely making that signal. But the economy, earnings, the leading indicators, everything else I'm looking at that looks forward to the economy, not just what's happening today, but looks forward, are still showing economic growth. All right, that can change. And when it does, we'll change what we're doing. But until it changes, you have to assume that this is one of those every 3-year downturns, and you rebalance. You have a high quality portfolio with really good holdings in it, very well diversified. And that's the strategy for this type of market. And you hang in there because that's where you make your money. The object is to get the money back. If you look at what has happened on these up days, the portfolio has really popped upward really strongly. So we don't want to miss out on those. We don't want to get defensive yet as far as that goes. We really want to see some of these economic things transpire. So that's what's happening right now. Kind of what the catalyst was today, what we're looking at in terms of things that we might do, which is a question I get quite often. When the market falls, what should we do about it as far as that goes? So anyway, that's what's going on right now. I want to thank you very much for listening. I look forward to talking to you tomorrow.